If you have ever been told you make too much money to contribute to a Roth IRA, that information was technically true and completely misleading at the same time. There is a fully legal IRS documented process that allows high earners to fund a Roth IRA regardless of income. The IRS knows about it, they have published guidance on it, they have never closed it. And most financial advisors mention it in passing without ever walking clients through exactly how it works. It is called the Backdoor Roth IRA. For 2025, if you are a single filer earning more than $165,000 or a married couple earning more than $246,000, you are directly barred from contributing to a Roth IRA, full stop. Except that is not actually the end of the story. Today I am going to show you exactly how the Backdoor Roth works, walk through every step of the IRS sanction process, expose the single most common mistake that turns this from a clean tax strategy into a tax headache, and give you the specific sequence to execute it correctly this year. Before we continue, everything in this video is for educational and informational purposes only. It is not tax advice, financial advice, or legal advice. Tax strategies involving IRA conversions have specific rules and potential tax consequences that depend on your individual situation. I am not a licensed tax professional or financial advisor. Please consult a qualified CPA or financial advisor before executing any IRA conversion strategy. With that said, let us get into the mechanism. Let me establish exactly what the income limits are and why they exist, because understanding the limit is what makes the workaround make sense. The Roth IRA was designed by Congress to encourage retirement savings, particularly for middle and lower income earners, by offering tax-free growth in exchange for contributing after-tax dollars. To keep the benefit targeted, Congress built in income limits. For 2025, the ability to contribute directly to a Roth IRA phases out starting at $150,000 for single filers and is completely eliminated at $165,000. For married couples filing jointly, the phase-out starts at $236,000 and is completely eliminated at $246,000. If your income exceeds those thresholds, the IRS rules state plainly that you cannot make a direct Roth IRA contribution. For years, that was understood to mean high earners simply could not access Roth IRA tax treatment at all. But in 2010, the IRS removed the income limit that previously restricted who could convert a traditional IRA into a Roth IRA. That removal, combined with the fact that there is no income limit on making a non-deductible contribution to a traditional IRA, created a legal pathway. You cannot contribute directly to a Roth IRA above the income limit, but you can contribute to a traditional IRA with no income limit and then convert that traditional IRA to a Roth IRA, also with no income limit on the conversion itself. That two-step process, contribute to traditional, convert to Roth, is the Backdoor Roth IRA. It has been used by financial advisors and informed taxpayers since 2010. It is documented in IRS guidance, and every tax season it remains completely legal. Before walking through the mechanism, let me make the case for why this is worth the extra steps, because the backdoor process does require more effort than a direct contribution. A Roth IRA offers tax-free growth and tax-free qualified withdrawals in retirement, unlike a traditional IRA or 401k, where withdrawals in retirement are taxed as ordinary income. Every dollar of growth inside a Roth IRA, accumulated over potentially decades, comes out completely tax-free, provided you meet the holding period and age requirements. For a high earner in their peak earning years, likely in the 32, 35, or 37% federal tax bracket, the value of tax-free growth compounds significantly over time. If you contribute the 2025 maximum of $7,000 per year, or $8,000 if you are 50 or older, into a Roth IRA via the backdoor method starting at age 40 and continue for 25 years, assuming an 8% average annual return, your account could grow to approximately $574,000 by age 65, entirely tax-free on withdrawal. Compare that to the same money growing in a taxable brokerage account, where capital gains and dividends are taxed along the way and upon withdrawal. The tax-free compounding advantage of the Roth structure, applied consistently over a multi-decade career, represents a meaningful and growing gap in after-tax wealth for high earners who are willing to execute the extra steps the backdoor method requires. There is also no income limit on Roth IRA conversions, and unlike a 401k, Roth IRAs have no required minimum distributions during your lifetime, meaning the money can continue growing tax-free for as long as you choose not to withdraw it and can be passed to heirs with continued tax-free growth potential. But here's what nobody is telling you. The backdoor Roth mechanism itself is actually simple. 4 steps. What trips people up is not the mechanism. It is one specific IRS rule that, if ignored, can turn a clean tax-free strategy into a partially taxable mess. I am going to walk through the mechanism first, and then I am going to make sure you understand the trap before you execute this. And if this is opening up a strategy you thought was closed to you, subscribe right now. We release financial investigations exactly like this 3 times every week, all free, all covering the legal strategies that high earners use and that most people never hear explained clearly. Here is the backdoor Roth IRA mechanism. 4 steps. Step 1. Open a traditional IRA if you do not already have one, or use an existing traditional IRA that has a 0 balance, which matters, and I will explain why shortly. Any major brokerage, Fidelity, Vanguard, or Schwab, allows you to open a traditional IRA for free with no minimum balance. Step 2. Make a non-deductible contribution to the traditional IRA. For 2025, the contribution limit is $7,000 if you are under 50, or $8,000 if you are 50 or older. Because your income exceeds the Roth limits, and assuming your income also exceeds the traditional IRA deduction limits, if you or your spouse have access to a workplace retirement plan, this contribution is made with after-tax dollars and is non-deductible. You report this on IRS Form 8606 when you file your taxes. This form is critical and we will come back to it. Step 3. Convert the traditional IRA to a Roth IRA. This can typically be done online through your brokerage in a matter of minutes or by calling your brokerage's IRA conversion department. There is no income limit on conversions. You are moving the money from the traditional IRA into a Roth IRA account. Step 4. Pay any tax owed on the conversion. Here is the key detail. If your traditional IRA had a 0 balance before this contribution, and you convert shortly after contributing, before any investment growth occurs, there is typically no tax owed on the conversion because you already paid tax on that money when you earned it, and it has not grown yet. This is what makes the backdoor Roth clean when executed correctly. Contribute, then convert quickly, ideally within days, before the money has a chance to generate any gains that would be taxable upon conversion. After conversion, the money sits inside your Roth IRA and grows completely tax-free from that point forward, subject to the same rules as any other Roth IRA contribution. Stay with me because the 4 steps I just walked through are clean and simple if one specific condition is met. If that condition is not met, this entire strategy can trigger a tax bill you did not expect. This is the single most common mistake people make with the backdoor Roth, and I am about to make sure it never happens to you. Here is the trap. It is called the Pro-Rata Rule, and it catches people who have existing pre-tax money in any traditional IRA, SEP or simple IRA account. The IRS does not let you choose to convert only your new non-deductible contribution if you have other IRA money that includes pre-tax dollars. Instead, the IRS requires you to calculate the conversion on a pro-rata basis across all of your traditional SEP and simple IRA balances combined. Here is a concrete example of how this goes wrong. Suppose you already have $93,000 in a traditional IRA from a previous 401k rollover, money that was entirely pre-tax. You then contribute $7,000 as a new non-deductible contribution, bringing your total traditional IRA balance to $100,000. Of that $100,000, $7,000, or 7% E, is after-tax money. $93,000 or 93% E is pre-tax money. If you then convert $7,000 to a Roth IRA, the IRS does not let you treat that $7,000 as entirely the non-deductible contribution you just made. Instead, the conversion is treated as 7% non-deductible and 93% pre-tax, meaning 93% of your $7,000 conversion, or approximately $6,510, is taxable as ordinary income in the year of conversion. You end up paying tax you did not anticipate on money you thought you had already paid tax on. This is the Pro-Rata Rule, and it is the single biggest reason backdoor Roth conversions go wrong. If you have any existing pre-tax balance in a traditional SEP or simple IRA, the backdoor Roth strategy becomes significantly less clean, and in some cases not worth executing without first addressing that pre-tax balance. The most common fix, if your employer's 401k plan allows it, is to roll your existing pre-tax traditional IRA balance into your current employer's 401k before executing the backdoor Roth. 401k plans are not included in the pro-rata calculation, only IRAs. Once your traditional IRA balance is at or near zero, the backdoor Roth becomes clean again. Here is your action plan. 5 steps, specific to executing this correctly this year. Step 1. Check your existing IRA balances. Log into every traditional SEP and simple IRA you have, including old 401k rollovers you may have forgotten about. If the combined balance is zero or near zero, you are clear to proceed directly. If there is a meaningful pre-tax balance, address Step 2 before continuing. Step 2. If you have a pre-tax IRA balance and your current employer's 401k plan accepts rollovers, contact your 401k provider about rolling your traditional IRA balance into your 401k. This removes that balance from the pro-rata calculation. Confirm with your plan administrator that they accept incoming rollovers before initiating the process. Step 3. Open a traditional IRA at Fidelity, Vanguard, or Schwab if you do not have one, or confirm your existing one has a zero balance. Make your non-deductible contribution, $7,000 if under 50, $8,000 if 50 or older for 2025. Step 4. Convert to Roth as soon as possible after the contribution clears, ideally within a few business days, to minimize any investment growth that would create a small taxable event upon conversion. Most brokerages allow you to do this online directly from your account. Step 5. File IRS Form 8606 with your tax return for the year you made the non-deductible contribution. This form tracks your basis in the traditional IRA and is essential documentation that prevents you from being taxed twice on the same money. Many tax preparation software platforms handle this automatically if you indicate the contribution was non-deductible, but verify it was filed correctly. Missing this form is a common and costly paperwork error. For free resources, IRS Publication 590-A covers IRA contributions including non-deductible contributions, available at irs.gov. IRS Form 8606 instructions are also available directly on irs.gov. And a fee-only CPA who specializes in tax strategy can review your specific situation, particularly if you have existing pre-tax IRA balances that complicate the pro-rata calculation. Before we close, one final reminder. Everything in this video is for educational purposes only. The Backdoor Roth IRA strategy involves specific tax rules including the Pro-Rata Rule, which can create unexpected tax consequences if not properly understood. Tax laws can change. Your individual situation, including existing retirement account balances, significantly affects whether this strategy works cleanly for you. Please consult a qualified CPA or financial advisor before executing any IRA conversion strategy. But here is what I want you to take from this video. The phrase "you make too much money for a Roth IRA" is true only if you stop at the direct contribution rule. The backdoor process has been legal, documented, and used by informed taxpayers and their advisors for over 15 years. The IRS has never closed it, despite ongoing discussion in Congress about doing so. If you are a high earner who assumed Roth tax-free growth was permanently off the table, it is not. You now have the four-step mechanism, the Pro-Rata Rule warning that prevents the most common mistake, and the specific action plan to execute this correctly this year. If this opened up a strategy you thought was closed to you, subscribe right now. We release financial investigations exactly like this 3 times every single week, all free, and I want to hear from you. Before this video, did you know the Backdoor Roth IRA existed? Comment yes or no below. I read every comment. I will see you in the next one.